China confirms 38K gold and $750 silver. Are you ready? Because the numbers being discussed right now are not projections, they are coming from trade data that has already happened. China imported more gold last month than almost any month in recent memory. And silver. Silver may be sitting on a number that sounds impossible until you see how the math actually works. $38,000 gold, $750 silver. Two numbers that, if they play out, would not just change portfolios, they would change how the entire world defines money itself. And by the end of this video, you will understand exactly why serious investors are no longer asking if this happens. They are asking when? Welcome back to Currency Arc Insight, the channel built for investors, business owners, and decision makers who track the real signals behind global capital, not the noise. If this is your first time here, hit subscribe so you never miss where the money is moving next. Drop a comment and let us know which country you're watching from today. In June, something quietly extraordinary happened inside China's economy, and almost nobody outside the metals industry noticed it in real time. According to trade figures released this month, China imported 173 tons of gold in a single 30-day period. To most people, that number means very little on its own, but when analysts converted it into ounces, the scale became impossible to ignore. 173 tons translates to roughly 5.5 million ounces of physical gold moving into one country in 1 month. This was not a random spike. It was the third consecutive month that Chinese gold imports had increased, and it marked the highest monthly total the country had recorded since March of 2024. When a government imports gold at this pace for 3 months in a row, analysts stop calling it a coincidence and start calling it a pattern. To understand why this matters, it helps to look back just a few months earlier. In March of 2026, China made a similarly aggressive move, but with silver instead of gold. That month, the country imported 270 tons of silver, equal to roughly 8.8 million ounces. For context, China's own 10-year average for monthly silver imports sits close to 100 tons. What happened in March was nearly 173% above that historical average. In plain terms, China was buying silver at a rate rarely seen in over a decade of trade data. When two of the world's most strategically important metals are being pulled into one country at this scale within months of each other, serious investors begin asking a simple but uncomfortable question. Why is this happening now? Part of the answer lies in China's broader posture towards silver over the past year. On January 1st, China banned silver exports entirely. This decision effectively cut off a portion of the global silver supply chain overnight, leaving manufacturers, investors, and governments outside China to compete for a shrinking pool of available metal. It was not framed as a minor policy adjustment. It was treated internally as a matter tied directly to national interest. This becomes even more significant when placed next to recent developments inside the United States government. Silver has now been formally added to the official list of critical minerals, a designation once reserved almost exclusively for materials tied to defense manufacturing and advanced technology. Alongside this classification, legislation has emerged specifically addressing silver supply security, often referred to as an act focused on strengthening license systems and supply chain resilience for critical metals. When a government begins writing legislation around a single metal, it is rarely because that metal is seen as optional. Taken together, these actions paint a picture that goes beyond simple market speculation. A major global economy is accumulating record volumes of both gold and silver, restricting the outward flow of one of those metals, and doing so at the same time Western governments are beginning to treat silver as a matter of national security rather than industrial convenience. For business owners, entrepreneurs, and anyone paying attention to global capital flows, this is not a story about a temporary trade fluctuation. It is a story about positioning. Nations do not import 5.5 million ounces of gold in a single month by accident. They do not increase silver purchases by 173% above a 10-year average without a strategic reason behind it. The scale of these numbers forces a reconsideration of what is actually happening beneath the surface of daily headlines. While most of the financial world remains focused on short-term price movement, one of the largest economies on Earth appears to be preparing for something far bigger than a single quarter or a single year. The question is no longer whether China is stockpiling strategic metals. The trade data already answers that. The real question, and the one this series will continue to explore, is what China expects to happen next, and why the numbers being discussed, including a possible $38,000 gold price, are being taken seriously by people who do not usually speculate. While gold has been grabbing most of the recent headlines, silver has quietly been telling an even stranger story, one that started long before this year's import numbers made news. To understand where silver is heading, it helps to rewind to the beginning of 2026, when China made a decision that sent a quiet shockwave through global supply chains. On January 1st, China officially banned the export of silver. At the time, many outside observers treated it as a minor regulatory update, the kind of policy change that gets a short mention in a trade bulletin and is quickly forgotten. But for anyone tracking industrial supply chains closely, this was not a small adjustment. It was a structural shift. China is one of the largest processors and refiners of silver in the world, and cutting off exports meant that a meaningful portion of global supply simply stopped flowing outward. The timing of this decision becomes even more interesting when placed next to what happened just 2 months later. In March, China imported 270 tons of silver in a single month, equal to roughly 8.8 million ounces. That number sits nearly 173% above the country's own 10-year average for monthly silver imports. In other words, China was not simply holding on to silver it already had. It was actively pulling in far more from the outside world. At the exact same time, it was blocking silver from leaving its borders. This combination, restricting outflow while dramatically increasing inflow, is not something governments typically do without a clear strategic reason. Businesses do not behave this way over a commodity they consider unimportant. Nations do not behave this way either. Around the same period, a separate but connected development was unfolding inside the United States. Silver was formally added to the government's official list of critical minerals. This list has historically been reserved for materials considered essential to national defense, advanced manufacturing, and technological infrastructure. Silver's inclusion signaled that policymakers no longer viewed it purely as an investment metal or an industrial input. They began treating it as something closer to a strategic resource, similar to rare earth elements or specialized alloys used in defense systems. Shortly after this classification, new legislation began taking shape, often referred to as an act focused on license integrity and vault expansion for critical mineral resilience. While the name of the legislation is technical, its purpose is simple to understand. It is designed to strengthen domestic control over silver supply chains and reduce dependence on foreign sources, a dependence that becomes far more concerning once a major supplier like China restricts its own exports. This is where the picture becomes especially important for investors and business owners to understand. Silver is not simply a precious metal traded for portfolio diversification. It plays a critical role in electronics, solar panel manufacturing, medical devices, and a wide range of advanced technologies. When a country that plays a major role in global silver processing begins hoarding supply while limiting what leaves its borders, the ripple effects extend far beyond investment markets. They touch entire industries that depend on a steady, predictable flow of this metal. For years, silver has traded in the shadow of gold, often viewed as the smaller, more volatile sibling in the precious metals world. But the events of the past several months suggest that narrative may be shifting. When a major economy classifies a metal as strategically important enough to restrict its export, and another major economy classifies that same metal as critical enough to legislate around its supply chain, it becomes difficult to view silver as simply another line item on a commodities chart. Instead, silver begins to look like something closer to a resource caught between two competing strategic interests. One nation trying to secure and control as much of it as possible, and another nation trying to protect its own access before supply becomes even more constrained. This is not the kind of dynamic that resolves quietly or quickly. For entrepreneurs and business-minded viewers watching global capital flows, this shift deserves close attention. Supply restrictions layered on top of national security classifications rarely lead to lower prices or reduced urgency. History tends to move in the opposite direction. As the following parts of this series will show, understanding this silver squeeze is essential to understanding why numbers like $750 an ounce are no longer being dismissed as extreme, but are instead being calculated, debated, and taken seriously by people who study these markets for a living. Numbers like $38,000 for gold tend to sound extreme the first time someone hears them. The instinct is to dismiss it as a headline built for clicks, rather than a figure built on actual math. But when the calculation behind this number is laid out step by step, it becomes clear why serious analysts are taking it seriously instead of laughing it off. The starting point is not gold at all. It begins with China's trade surplus. In 2025, China recorded a trade surplus of approximately $1.2 trillion. A trade surplus of this size means the country sold far more to the rest of the world than it purchased in return, leaving an enormous amount of excess capital sitting on its books. Normally, a surplus like this would be absorbed into foreign currency reserves, government bonds, or other traditional financial instruments. But that is not entirely what happened. Instead, analysts began looking at how much of that surplus lined up with China's gold purchases for the same year. When China's net gold imports for 2025, estimated at around 940 metric tons, were divided into the total trade surplus. The resulting number came out to approximately $39,000 per ounce. This is where the now widely discussed figure of $38,000 originates. It is not a random prediction pulled from thin air. It is a mathematical relationship between how much money China generated through trade and how much of that money appears to be finding its way into physical gold. This kind of calculation does not prove that gold will reach that price tomorrow, next year, or ever. What it does show is a possible framework for understanding China's long-term intentions. If a nation is systematically converting a meaningful share of its trade surplus into gold rather than traditional reserve assets, it suggests a deliberate strategy to reduce reliance on foreign currencies and build wealth in a form that cannot be inflated, frozen, or devalued by another government's monetary policy. Once this gold figure is on the table, the next logical question becomes obvious to anyone who understands precious metals. If gold moves that dramatically, what happens to silver? This is where the gold to silver ratio becomes essential. Throughout history, gold and silver have traded in a relationship to one another, with the ratio between their prices shifting depending on economic conditions, industrial demand, and investor sentiment. At various points in history, that ratio has looked very different. In modern trading, ratios near 50 to 1 have been common. Using that same 50 to 1 relationship against a $38,000 gold price produces a silver price near $760 an ounce, which is where the $750 figure many are now discussing comes from. But the story does not stop there because the ratio is not fixed. If the relationship tightens to 70 to 1, a level seen during periods when silver underperforms gold, the resulting silver price drops closer to $542. If instead the ratio moves toward 20 to 1, closer to levels seen during stronger silver cycles, the number rises to $1,900. Push the ratio down to 16 to 1, a level that held for centuries before modern paper trading systems existed, and silver's implied price climbs to $2,375. At the most extreme historical extraction ratio of 7 to 1, the same ratio in which the two metals occur naturally in the Earth's crust, the number balloons to over $5,000 an ounce. None of these figures are guarantees. They are mathematical outcomes based on shifting assumptions, and no serious analyst claims to know exactly which ratio will define the years ahead. What this exercise does reveal is something more important than a single price target. It shows how sensitive silver's potential value is to even small changes in its relationship with gold, and why a shift in gold's price alone could trigger a much larger percentage move in silver. For business owners and investors trying to make sense of these numbers, the takeaway is not to fixate on any single price point. It is to understand the mechanism driving the conversation. A trade surplus converted into gold, a historical ratio applied to that gold price, and a wide range of outcomes for silver depending on which version of that ratio ultimately holds. Whether the final number lands near $750 or somewhere entirely different, the underlying math explains why this conversation has moved from internet speculation into serious financial analysis. For decades, most people who wanted exposure to gold never touched an actual bar or coin. They bought paper claims, certificates, derivatives, and digital contracts that represented gold without ever requiring the metal itself to change hands. This system worked smoothly for a long time, allowing banks and exchanges to trade far more gold on paper than physically existed in vaults. But in July, China took a step that signals this era, at least within its own borders, is coming to an end. On July 24th, major Chinese banks began shutting down retail paper gold products. This was not a minor adjustment to a niche investment product. It was a deliberate move to eliminate the ability of everyday investors to hold gold in a leveraged, paper-based form. Instead, China has been actively pushing its population toward physical bullion ownership and direct settlement systems, where the gold being traded actually exists in a vault rather than as a promise on a balance sheet. To understand why this matters, it helps to consider what paper gold actually represents. In traditional financial systems, paper gold allows far more claims to exist than there is physical metal to back them. This works fine as long as most participants never ask for physical delivery at the same time. But if trust in the system weakens, or if enough people begin demanding real metal instead of paper promises, the entire structure becomes vulnerable to a mismatch between what is promised and what actually exists. By shutting down retail paper gold, China is effectively removing that vulnerability from its own domestic market. It is choosing certainty over convenience, forcing gold to function less like a tradable financial instrument and more like what it was originally intended to be, a direct store of value that exists physically rather than on paper. This shift did not happen in isolation. Alongside the retail shutdown, Hong Kong introduced a new gold clearing system designed to support physical settlement on a much larger scale. Instead of relying on Western clearing systems historically centered in London and New York, this new infrastructure allows gold transactions to be settled directly with actual metal changing hands rather than layers of paper claims moving between financial institutions. When paired with a retail shutdown on the mainland, the message becomes difficult to ignore. China is building an entire ecosystem centered on physical gold ownership and settlement, independent of the traditional Western paper-based system that has dominated global gold trading for generations. This becomes especially significant when placed next to everything discussed earlier in this series. A nation importing record volumes of gold and silver, restricting silver exports while national governments elsewhere classify it as a critical mineral, and now dismantling its own domestic paper gold system in favor of physical settlement, is not behaving like a country making isolated economic decisions. These actions form a pattern, one that points toward a broader strategic shift away from paper-backed financial promises and toward tangible, physical assets that cannot be diluted, defaulted on, or settled with anything other than the real thing. For business owners and entrepreneurs watching global capital flows, this pattern carries weight beyond gold and silver prices alone. It reflects a broader question about trust in financial systems built on leverage and paper claims versus systems built on physical ownership. When one of the world's largest economies begins visibly favoring the latter, it raises a legitimate question for investors everywhere. If the world's second largest economy no longer trusts paper gold enough to offer it to its own citizens, why would the rest of the world continue treating it as equivalent to owning the real metal? None of this guarantees that gold will reach $38,000 or that silver will follow to $750. Markets remain unpredictable, and no single data point determines the future with certainty. But when trade data, supply chain restrictions, national security classifications, and now a structural shift away from paper gold all point in the same direction, the conversation shifts from speculation to serious analysis. What is clear is this: China is not simply buying gold and silver as a passive investment. It is actively restructuring how these metals move, how they are settled, and how much physical ownership matters within its own financial system. Whether or not the specific price targets discussed throughout this series ultimately prove accurate, the underlying strategy they are built on reflects an economic shift few investors can afford to ignore.